Well, joining me today is a name synonymous with conviction investing in India. Ravi Dharamshi, founder and CIO at ValueQuest Investment Advisors. He's building a reputation for identifying mega trends early and having the conviction to stay with them. Names like Loris Labs, Root Mobile were flagged off by Ravi and his team well before the street caught on. His investing philosophy rests on three pillars, which is the wisdom to see, the fortitude to hold, and the courage to capitalize. Today, he joins me right here in the studio to talk about ValueQuest's latest thesis, which is the great physical rebuild, which argues that the world is entering into a synchronized global CapEx supercycle, with India sitting right at its center. Ravi, welcome to the show. Thank you so much for your time today.
Thank you for having me, Aisha. It's my pleasure.
Ravi, where are we right now in this market cycle? I want to understand the big picture with so much news flow, so many things fluid, West Asia. One day you think it's settled, the other day it's not, apparently. Where are we headed?
Yeah, so, you know what, there is one global cycle that is panning out. There is one global economic order that is changing. Then there is the global market cycle. Within that, India's cycle has been separate. It has been kind of different. So let me cover one by one. So I want to first say a little bit about this global order that is changing. If you go dial back, let's say during the COVID times, we suddenly realized that we were too dependent on one nation for a lot of our supplies. Or not only we, as in the world realized.
The world was, yeah.
Also, the supply chains were essentially very, very fragile. Then in 21, we saw that because of the Red Sea skirmish, again, supply chain got impacted.
Sure, yeah.
The semiconductor shortage showed that auto chains were very, very fragile. Then in 22, Russia-Ukraine war showed that you cannot be dependent on a rival nation for your energy needs. You need to become energy independent, energy secure. Then again, similar kind of things panned out in 23, 24, where, if you remember, one tanker got stuck in Suez Canal,
yes,
and that led to supply chain getting disrupted. Yeah. Then again, the current West Asia war. These are all manifestation of, these are mini crises that the world has lived through, and again, the same message is getting reinforced to everybody, that the old world order, which essentially organized itself around the principle of cost efficiency, just-in-time supply chain, is no more valid. You need to have redundancy, you need to have resilience, and you need to build stronger supply chains. You need to be energy independent, you need to be energy secure, you need to have your own presence in the key strategic area, you need to fend for your own self. You cannot take it for granted that there is one hegemon which will give you protection. You need to essentially
be self-sufficient.
Be self-sufficient in a lot of the core strategic areas. So manufacturing, industrial base, supply chain, energy independence, defense, aerospace, all this is essentially pointing to the fact that the world is moving towards something that we call as sovereignty. It is moving from cost and efficiency to resilience. So that is the world economic order that is changing. And now, why did this world order, we went through the mini crisis, but the larger forces behind it is that there is a aging superpower and there is a rising superpower. And the gap between the two is reducing by the day. And that is threatening the aging superpower. And on to top of it, they have piled on debt, they are running deficits, and they have a reserve currency to take care of. So everything is putting a restriction on them, and that is what is driving the behavior, which is leading to the world being from a unipolar to a regional or a multipolar world. So a lot of these sovereign decisions have now reached the corporate world, because the money is also starting to flow in that direction. So people are beginning to see that the governments of the day are deciding where the capital gets allocated through, of course, through carrot and stick approach, or through protection, through incentivization, and that, for example, we saw overnight the tariffs being imposed. Essentially, where is this coming from? Because the side effect of the 30 years of
Debt accumulation.
the debt accumulated because the globalization led to the hollowing out of the industrial base of the Western world, whether it was the US, Middle America, or the Western Europe. The industrial base was hollowed out, and now they are finding themselves very vulnerable. So they need to rebuild. So that is where this whole thesis is coming from, that it is not only AI. Of course, AI is the most visible face of this particular CapEx cycle that is panning out, and probably the biggest also. But at the same time, there are many other things which are driving this whole physical rebuild. And India, initially, of course, India, the popular narrative is that India is an anti-AI play. But what my contention is, it is not an anti-AI play. It's just that AI might not have representation in the indices at this point of time, but below the surface, there are enough and more second-order stories of AI that we can play. So we might not have the frontier models of,
LLMs.
No, from GPU, servers, memory, those are not the areas in which we are competing. But if you look for, cooling solutions, switchgear, cables, connectivity to the grid, those are all still good 30-40% of the overall AI capex build. So that so India actually was on the verge of a cyclical revival before this West Asia war broke out, and that has kind of put pressure on our macros. So we need the central government capex to be replaced by private sector capex cycle. Now that private sector capex cycle, what I am saying is that because of this AI build out, that it is well and truly the global tailwind in the industrial capex cycle is going to help India as well. And we are already seeing initial signs of the kind of credit growth and everything that is picking up in India. But I think it will accelerate further. So just to summarize, there's a global industrial capex cycle playing out because of the change in the world order, which is going to play into an economic revival in India, where the baton changes from central government to private sector, where they will carry on the global capex cycle, the private sector capex cycle further. And for that, the missing piece was the confidence, and that confidence seems to be coming back.
What I want to pick up on the point is, what you're calling in your latest report, the physical rebuild that's happening in the entire globe. Tell me specifically whether Indian equities are pricing in what India has to gain out of this physical rebuild, which is currently at play in the entire world.
Yeah, so clearly, market has recognized. It's not like it's a new thing. But if you take a step back, market, what is probably not priced in is the fact that it is not only an AI cycle. It is not only a defense cycle. It is not only a power grid infrastructure build-out cycle. And one is the synchronicity of all these cycles playing out and all these themes playing out. The second is that these themes tend to put the pressure on the same physical ecosystem of you will need engineers for it, you will need electrical ecosystem for it, you will need a manufacturing base for it, you will need the same critical minerals for it. So there are multiple tailwinds driving this entire layer of physical infrastructure build out, and that is where India has a role to play, because India has the highest number of engineers that are being churned out. India is now becoming part of the AI build-out also. So about 150 gigawatt of AI data center build-out has been announced. About approximately 20 gigawatt is announced in India. So that is a significant chunk. And to put it in perspective, 20 gigawatt will mean roughly $200 billion of capex. Now, $200 billion of capex in Indian context is significant. Yes, most of the beneficiaries, let's say 50-60% might be outside of India. You will see the Korea, Taiwan. Essentially, the memory, compute, chips, servers are not where India will have a play. It's the other piece where India is beginning to have a play. But we started off, for example, medium voltage switch gears. We started off thinking that, because of the energy transition, that there will be a demand for building a power grid. But suddenly AI is actually adding to the pressure and in fact accelerating the whole thing. So there are second order beneficiaries of AIs, and I think market is not yet realizing that this is going to be a prolonged cycle, synchronous cycle, and in a way not only an economic cycle. So it is a indiscretionary spend. So a lot of people say, if the funding stops for hyperscalers, how will this CapEx pan out? Or if the economics don't fall in place, how can you justify doing this CapEx? Now, you explain to me why was US, banning the use of Fable for, other nations or whoever is not trusted. It reveals the mindset. It tells you that AI is in the same league as the nuclear race of the last millennium or the space race. So it is as much a sovereign driver as much and not only economics. Economics have to fall in place. Just think about it. If Google is spending X amount, can Amazon afford not spending as much? Can you be underbilled? Will you end up overspending and will you end up overbuilding it? Surely. And will the economics, I don't think the economics are falling in place in the next 2 years. It will fall in place eventually. But does that mean that the physical build out of the AI data center is not likely to happen? I think that is far harder to reverse. One particular project might get stuck or something like that, but the overall build out is going to happen because it is indiscretionary in nature. It is not only based on economics. It is based on the fact that US needs to maintain its superiority in technology race, and it is also driven by the fact that at company competition level also you need to be ahead of your competition because it's not a choice anymore. So that is what gives me a lot of confidence that this cycle is not going to get over. Of course, we might have phases where we will keep questioning and we might have doubts and we might call it a bubble from time to time. But I don't think it is, even if it is a bubble, it is going to get bigger before it bursts.
Ravi, you set off giving the entire global context, but specifically talking about India, if there are so many catalysts at play, and if the world is headed towards now sovereign AI, as you beautifully justified, why is it not reflecting in earnings, in FII flows at large at an index level still?
So first of all, let's take the FII flows because that's the easier one. First of all, even despite the fact that Korea and Taiwan are a direct play on the AI CapEx, they have witnessed outflows. How do you, markets might have done very well.
Yes.
No, not last month. There has been last full year, it's net negative in Korea and Taiwan as well. The money has moved because the mothership is US. And the earnings story over there has been so strong that it is the magnet that has drawn money from everywhere else. And unfortunately for Taiwan and Korea, another problem is they are too dependent on one or two companies. Like 2 companies make up 35% of the index. So automatically they have to readjust and sell because you cannot be overweight to a particular company. In most of these global allocation and global mandates, along with index exposure, you need to limit your exposure to a particular company. So if you have 100 rupees allocated to Korea, you cannot have 35 of that allocated to only 2 companies. So that is why they are being forced to sell as well, despite the fact that probably the AI, and of course it is the leverage story, the local leverage story in Korea is making the moves far more volatile than they should be. So now that is, so India is also part of that emerging markets group which is seeing outflows. But if you see in the last couple of months, this outflows has slowed down. Probably even a little bit of trickle of inflows have also come in. And it is probably more to do with the fact that the valuations have become attractive. Essentially, it is IT and financials, which forms almost 40–50% of the index. And that particular part of the index has witnessed the maximum outflows. And now we are reaching a point where there might be some selling exhaustion. But the reason why the money has not come in is because our earnings growth trajectory has not been commensurate either with the valuations that we were trading at or with the other options that are available out there to a global allocator. So if that is the case, the money is not going to come in. There have been, but if you look at it, the last 3 months, the mid and small cap have outperformed the the benchmark indices by almost 18-20%. There has been a huge outperformance. So below the surface, market is already beginning to recognize.
There's a different bull market.
Correct. There is a bull market going on over there. It is not like, it's just that if you are bullish on Nifty, then you are going to be disappointed. But are there wealth creation stories panning out below the surface? I think more than 200 companies probably would have made 52-week high or an all-time high in the last 3 months. So there is enough and more to generate alpha out there.
But, you know, at a macro level, in your recent note as well, Ravi, you've highlighted and you've compared India's current setup to what was happening in China in 2001, right? When you had cleaned up banks, deleveraged corporates, spending ramp up. Do you think we're at the cusp of that China revival moment here in India?
Yes, I do think so. In fact, so what panned out beautifully at that point of time, let me just juxtapose the two cycles.
Sure.
At that point of time, in global CapEx cycle, China was the only driver. And essentially, the prime beneficiary of that China industrialization cycle was the commodities. But India benefited disproportionately because even a $20-30 billion inflow into Indian market meant huge gains. And similarly, $20 billion outflow meant huge destruction. So we were very heavily dependent on foreign flows at that point in time. But now, as compared to that, today's cycle is actually much broader. It is not only focused on the commodities, it is actually focused on the entire, there are many themes running right parallelly. So from aerospace, defense, semiconductor sovereignty, energy transition, power grid capex, all these themes are essentially, and it is a global theme. And as I mentioned, the nature of this is, one, it is spread out geographically, and second, it is indiscretionary in nature. So the cycle is probably, in terms of duration, going to be longer. And in terms of intensity, I do believe that it will be higher because of, one, AI adding fuel to the fire. And so we have done some work which says that the capex intensity to the global GDP in previous cycle, we have studied 5 cycles over 200 years. And generally, these are cycles where we say, you know, a general purpose technology, which is going to dramatically change the way things are done, collides with a shift in economic order that has been created. For example, in early 1800s, the steam engine came along when the British power was on the rise. And that actually accelerated their expansion, and that gave birth to a boom. In fact, I mean, just to give you a nice anecdote, you might not know, but the rise of Bombay owes its, it's a beneficiary of an American Revolution, American Civil War. Because of American Civil War, there were only 3 sources of cotton: US, China, and India. And because of American Revolution, the cotton stopped flowing to Britain, and Britain was the center of the world at that point of time. So suddenly Bombay became a hot center for all the cotton. Sourcing cotton. And that is why railway got built in India, because they wanted to bring cotton from the hinterland to the port. So similarly, I mean, if you study all the cycles coming back, the intensity of capex to the GDP was about 23-24%. If we were to add up from whatever projections that we have seen or the announcements we have seen, this time around the intensity might peak at around 28-30%. Now that is a significantly larger capex cycle panning out. So that is what is giving me a lot of confidence that despite the fact that we have not yet participated, the global tailwinds are going to be so strong that India will also get lifted as a boat. But of course, right now it still remains very selective in terms of where the wealth is getting generated.
You know, the other thing, Ravi, that you were mentioning was that the government has to do enough for the private capex to kick in. If I look at the quality of balance sheets of banks right now, NPA ratios are down to 2.25%. Credit growth is back to 17 to 18 odd %. Is this the time when you will finally see private capex pick up? Because if we miss the boat now, then it's going to take a long into coming.
Yeah, so I think in fact I believe that there has been a 2-year delay. The capex intensity of central government peaked in 2024, and the private sector capex cycle is picking up now. So there we had a 2-year gap. While what panned out in the previous cycle in 3 to 8, there was a nice transition. The capex intensity of central government led in 2001, 2, 3, 4. Suddenly in 2004, government changed. Now, because of the change of the government, the capex intensity might have not slowed down, but the consumption also picked up. And that led to the cycle getting elongated, and there was no interval in between. But in this cycle, what we have seen is the last 2 years that there was a little bit of slowdown. Why was that? Because in 24, when the elections were there, at that point of time, 5-month period where the central government could not spend money. Now, after that, now the government is getting more and more constrained, whether it is the state government or central government, their ability to spend. They grew from 2020 to 2024 almost at a 25-30% clip. Now they can grow at 10-12% clip. They cannot continue because the base has become much higher.
Larger, yeah.
So from 6 lakh crore annual spend, we have come to almost 12 lakh crores. Now from 12 lakh crores, we can grow 10-12%. So now if we want to push the GDP envelope to 8% or beyond, then the private sector capex cycle has to pick up, which is picked up, but it is still at 10-12%. We need to see private sector accelerating at 20-25%. And if that happens, then we will see the GDP also flowing and growing at 8% or so.
But as an Indian investor, is the message don't bother about what the Nifty is doing, because that's a function of what banks and IT are up to, and that may not be the true picture, because all these AI beneficiaries that we're talking about are in this mid space.
Yeah,
should Indian investors look at it as a more stock-specific, company-specific story, as opposed to being an index, heavyweight, large cap-led story?
Unfortunately, Nifty is a lagging indicator, and it will follow. There will be changes made in the indices over the next couple of years where some of these new, well, they are not really new age industries, but industries which are becoming the new center of focus, where the earnings expansion, profit pools are getting created. So these, you will see renewable energies becoming part of indices, defense companies becoming part of indices, semiconductor value chain, all power grid, all those kind of companies will become part of the indices. But unfortunately, they will be lagging indicators. They will not be leading indicators. On the other hand, the banking and IT were actually a drag on the index. I think IT is initially it is going to be at the receiving end of this AI revolution, because Indian IT industry's business model is essentially labor cost arbitrage, and it is based on time and material. Now, so if a guy in US could do it for $100 an hour, a guy in India can do it for $20 an hour. And now AI can do, if instead of 10 people, 2 people can do it, and at almost half the time and 1/10 or 100 the cost, then obviously that business model is going to face a challenge. But having said that, probably there is a 3-4 year transition phase. After that, AI enterprise and services around it will become large enough portion of the revenues of these large IT companies, and that will also show growth. But I think that's a story for the phase 2. Today, they are a net negative impact of AI. I very strongly do believe that all the acquisitions that we are seeing in the IT space are essentially to buy growth, and that is not going to buy growth, because you are buying to just stay in the same space, and you will see that the revenues roll off much faster. So that is the negative side of AI story on India. Banking has been having its own challenge on the NIMs front, but I do believe we are reaching a phase where NIMs are also going to bottom out. Asset quality is not an issue, and growth, now there is a very benign regulator that is pushing for growth. So all three, the troika of NIMs, growth and ROE expansion is going to happen, and that means and also the relative valuation of Indian financials versus the global financials has become very attractive. So I don't see fundamentally them correcting a lot more from here. Money should start flowing in, and so maybe Nifty will also start participating soon enough, but right now it seems more like a value call rather than a growth call.
for now, you're saying you can ignore the Nifty, work on, or do your homework on this physical rebuild which is happening?
So personally, I mean, that's always how we have approached it. We never look at the market from, we are index agnostic, we are market cap agnostic. We look for where the opportunity is opening up and we go after that. I mean, yes, you have to, if the opportunity set is small or if it's in the small cap company, you cannot deploy the kind of capital that you can deploy in a large company. But you still have to keep your eyes focused on where the opportunities are opening up rather than I'm not a mutual fund manager that manages lakhs of crores. So it is not my problem that I have to think in large cap bucket and mid cap bucket and small cap bucket terms. For a person with a limited means and limited capital,
You're flexi-cap forever. Let's just put it at that.
There are enough and more opportunities available to generate alpha and wealth.
Understood. You know what I really liked in your note is that you've mentioned that AI is the catalyst, not the destination. And you've given us enough examples as of now, and one related to Bombay and how Bombay really came about. Let's talk about the structural drivers in place and where is it that there is investable value in Indian equities in this entire AI sort of physical rebuild which is happening.
No, so as I mentioned, if 1 gigawatt of AI data center means about, I think, somewhere around 15,000 crores, roughly about $2 billion of CapEx. But if I were to remove compute, memory, chips, servers from this, then the value that is remaining is civil construction, the cooling solutions, the power, cable, connecting to the grid, those kind of things remain, which will be about 30-40% of that CapEx. So there is a lot of play available over there. Now, because the energy transition theme started much earlier, some of those stocks did get recognized and rallied on that. But AI as a theme in itself is, I think, just about beginning. There are some smaller cap companies. So a company which is probably supplying, heat exchanger, or a company that is supplying bushings which go inside a transformers or medium voltage transformers. These are the areas, or cable companies for that matter, power cable. These are the areas where the opportunity is there. Market has recognized. Now, the optionality that is probably not priced in is that these companies, along with catering to the domestic capex, might be eligible for playing in the export market as well. Because, number one, we are still part of that larger story where the excessive dependence on China is forcing the corporate boardrooms to develop other sources. Second, because the demand is so high that these players are finding it difficult to supply. The order books have swelled. The lead times of delivery are 18-24 months out. And these hyperscalers cannot afford a delay in that build out. So they are looking for alternative suppliers as well. So which opens up another market for Indian players. So yes, the stocks have rallied. Stocks might be expensive from the current year or next year earnings point of view. But I think because the early stage, it's still early stage of the cycle is going to be much bigger and prolonged, that these companies can still make absolute money even from here.
So you're saying picks and shovels businesses for the AI theme, net.
So for us as a philosophy, picks and shovel has been the play usually because the certainty of making money is very high. Yes, if you are one of the frontier model developing LLM or developing the real bottlenecks, which is the memory, the chips of the newest technology, you might capture a far larger pie of the AI data center capex. But even what matters to us is the delta. A small company, making 100 crore PAT company, if it can become a 500 crore PAT company, that is an opportunity to make money. So we might not be capturing the billions and trillions of dollars, but there are enough companies who are showing this kind of trajectory where the profit growth is exponential over the next 3, 4, 5 years. And they might look expensive from the 1 year forward perspective, but from 3-5 year perspective, they might still be there might still be a lot of money to be made. So that is where we are in the cycle. It is always challenging because PE multiple, as much as people want to not focus on it. It is a shorthand for valuation, and people say ATP multiple is expensive. So, I mean, nothing to take away from that, to each his own. But I do believe when you are playing a CapEx story, you should ideally try to figure out how the cycle will play out. Has the order book peaked? Has the margin peaked? Has the CapEx of the end customer peaked? Those things will tell you whether the stocks will get cheaper or will these kind of valuations sustain. We might have a 6-12 months of no returns or even some correction, but if the cycle is not over, then there will be a new rally again at some point.
But you know, Ravi, you've always talked about the layer 1, layer 2, layer 3 framework, right? When you talk about this physical rebuild led by AI, classify where does India lie and where do Indian businesses lie in these entire three themes?
So unfortunately, in the first layer, which is the layer which is building the LLMs, we are not present.
We're nowhere there, yeah.
The layer 2 is the key infrastructure, which is again the chips, servers, memory, compute. We are not there. Layer 3 is where India's story starts, which is essentially connecting that GPU to the grid, or cooling it down, or the civil construction around it, the EPC players, the components that go into each of those things. So the layer 3 is where India is going to play, at least in this particular cycle. Can we at some point of time hope to have our own LLM and become cutting edge in semiconductor? Maybe, but that is not the next 5-10 year story. It might be much beyond that. We are just starting off in the semiconductor value chain. We cannot even hope to be at the cutting edge of it. So, but it is important to at least become part of that story even right now. And I think the Semicon 2.0 that government announced is essentially a great thing, because in the semiconductor 1, it was only about Semicon 1.0, it was only about the fabs, packaging units, and the larger companies, those who will do the CapEx. But now the 2.0 is more about developing the entire manufacturing ecosystems around it that goes into semiconductors. So from chemicals to electronics, everything that goes into the chip making, this will be a huge boon. Now, and these opportunities are catered by very small companies. So there is an opportunity to make ton of money over here. So our story is a little second, third order derivative of the AI, and it is not a direct play. So and it is not even also, and it has no representation in the index, and that is why the narrative of India as an anti-AI play has become popular.
But you know, just talking about that, since it is layer 1, layer 2, layer 3, from what I understand is that layer 1 is what's going to make maximum money always also, right?
So maximum money, but for a minority shareholder, what matters is not necessarily the only amount of money, but it's the delta, the change in the amount of money you're making today versus what you can make 5 years down the line. As I just gave you the example, so many companies we are seeing which are at around 100 crore PAT, which can potentially be 500 crore PAT, and that journey of 100 to 500 can be covered in a 2-3 year time frame. If not, 5 is an outside limit. If that kind of explosive growth is happening, I don't have to, as a stock picker, I don't have to worry about the fact that I don't have Nvidia or TSMC or Micron in my portfolio. There are enough and more opportunities to make money in India.
But Ravi, that layer 3 explosive growth is not going to find global takers, right?
No, 100%. But there will be, see, it's a combination of one, the opportunity size, and two, who has the right to capitalize on that opportunity. So it's a combination of the delta in opportunity and also the industry structure. Now, I'll just give you an example that there are many listed MNC companies in India which are not listed anywhere else except their home market. So, I won't name them, but if there is a consolidated industry structure with very few players addressing that opportunity, and that opportunity has a very high probability of panning out, then you have an ability to make fantastic money over the longer term. And that is good enough for me to generate returns. I mean, India as a nation, yes, it's a long journey that we have to undergo. But me as a minority shareholders will find enough opportunities to make money. So it doesn't matter if I don't own Nvidia, I will own a tier 2 vendor or a tier 3 vendor to those guys, those who are spending the money, and that is good enough to generate returns.
You know, you also highlighted that India is very uniquely getting a domestic cyclical story in place or recovery in place and a structural global tailwind also at the same time. If I were to ask you, give me one sector that captures both of these tailwinds in one go, which one would it be?
Domestic CapEx cycle as well as a global. As I mentioned, so I think the bottleneck, you have to figure out where the bottleneck is. And that bottleneck will tell you where the opportunities are opening up. So, for example, today it is an imperative for the AI data center build out to happen and happen as of yesterday. Now, what are the bottlenecks over there? In US itself, the biggest problem is connectivity to the grid. Now, they don't have the power. The biggest, what is a data center? Data center is a large room with connectivity in terms of internet connectivity. Second, lots of power. Third, water. These are the three things. At the bare bones skeleton structure, that is what a data center is. So anybody who helps in connecting to the grid or help in cooling down the servers that are getting hot are going to be the one that will be benefiting. And these are bottlenecks as of today. So within connectivity to the grid, transformer is the bottleneck. Within transformers, let's say a small component like bushing is the bottleneck. So you find companies, and once you see that there are very few companies who are making these kind of components, then they will have a 5-year, maybe 10-year visibility in terms of what kind of scale change that those businesses can undergo. And that's where the wealth is going to be created. So, I see enough and more opportunities.
So you're saying ignore the valuations right now, look at the India AI index, if I can call it that, and even right now they're a good value proposition from a 2-year hence time frame.
No,
right?
I am not saying ignore the valuation, but I think just judging the valuation based on current year's number or FY27 numbers might not be the right prism.
Sure.
What you need to understand is where are we in the cycle? What you need to know is, has the ordering cycle peaked? Has the margin cycle peaked? Is the capacity utilization is at its peak? Those are more an indicator of whether the, and to those peak of, peak drivers of P&L, market has assigned a very high multiple, then you are at a problem. And also if you have taken on a lot of leverage for that CapEx, then it also adds to the fact, then we are going to have a lot of problem. But I don't think we have reached that stage. The balance sheets are still, unlevered. The ordering is still accelerating. The margins have not yet peaked. Tells me that the cyclically adjusted PE is not at a peak. So current year might look at a peak, but you have to look at the CAPE ratio or a PEG ratio, which is PE to growth, and cyclically adjusted PE might give you a better sense of where we are in the valuation. Just to dumb it down a little bit, if a company is making 100 crore profit, let's say it is getting a 50p multiple, so it's a 5,000 crore market cap. Now there is a possibility that in this particular cycle, this company scale might change and it might become a 500 crore or a 1,000 crore PAT company. Then you are essentially, it is a 10p multiple or a 5p multiple depending on where the peak is. And now what you have to do is assign probability to what is the probability of that 500 crore and 1,000 crore PAT outcome, how soon can it be achieved, and that will tell you that, okay, even if I take my exit multiple as, this business in its in a normal state does not deserve a 20p multiple, more than 20. So even with 500 crore PAT and 20p multiple, you can get a 10,000 crore market cap. And today it is available at 5,000 crore. So you can see a doubler in a 3 to 5 year time frame. Now, for a lot of investors, that is a good enough return. So that is why these stocks are not going to get cheap. And being focused only on the current year multiple might make you miss some of this opportunity.
Understood. Where else in the market do you have this kind of conviction, I'm wondering, outside this sector?
Aerospace, defense, entire semiconductor ecosystem is still coming up. Energy transition, within energy transition also there are changes happening. Earlier on it was only solar module manufacturing, then cell manufacturing, then it is going to go to wafer. Companies are diversifying into hydrogen, batteries. Batteries is going to be the next thing, because if you see last year, we saw almost 50% of the power generated through solar in Rajasthan could not reach the grid. There was no connectivity available. And at a national level, almost 12%. So that's a huge number of power which is getting generated, but is not being fed to the grid. What is the problem? Problem is there is a mismatch between the demand and supply. The demand peak tends to be in the morning hours and in the evening hours. And at that point of time, solar is not able to generate power. So you need to have battery so that when the solar generates the power, you are able to use it at those peak hours, and that will
storage issues.
Storage, and that is, and now through government policies and regulation, almost it is becoming a mandate that batteries need to be part of the tenders that are being given out. So earlier it was only solar tenders. Now it is solar plus wind, or solar plus wind plus battery, or FDRE contracts. Those are the kind of changes that are happening in the energy transition cycle. That phase will play out. Then we might move to hydrogen, because hydrogen is also a next big play in the energy transition. Electrification of EVs. I think we have just embarked on the two-wheeler electrification. The PV electrification is still ahead of us. Yeah. So there are many sub-themes within the energy transition themes also. So it is not only about AI data center CapEx theme. And good thing is, all these still play into the same ecosystem of building an industrial infrastructure base. So anybody is supplying a PCB board or supplying equipment that connects the grid are all going to be a beneficiary of multiple themes, not only of AI, but also from defense, maybe from space also, if I were to say. Space is also going from just being a sci-fi movie-oriented or a government's domain to a commercial
private sector.
Private sector has been opened up in India also. Yeah. So the new profit pools are emerging from these sectors, and again, those rockets will need those same PCB boards which are being manufactured for defense application as of today, or for some other application. So it is going to put the demand on the same set of infrastructure, physical infrastructure, and that is why these companies might see a tremendous scale change.
So basically, bet on India of the next 5 years as opposed to looking at where we are right now.
Yes, absolutely. And next 5 to 10 years, I think a lot of these companies, just the traditional mindset about FMCG or those kind of things, you will not get that kind of growth. Market might have its cycle. At some point of time, it might be so that the growth gets valued fully, and we might switch back to finding safety and cash flows and those kind of things. But I don't think that is the stage today. At that point of time, these companies might come back into the favor, which is the consumer staples of the world.
Interesting. So if I were to ask you, which are of these sectors, or rather their constituents, because you're not going to name any companies or stocks, I'm sure, will make it first to the index? Stick your neck out for us.
No, so the making it to the index will require size. So I think a defense company, a renewable company are definitely candidates, and a power grid infra company are definitely candidate to make it to the index in the next, 6-12 months. So because their market caps have now started touching between 1 lakh and 2 lakh crores. So, that is the space that I would look at as which are the companies which can possibly become part of this. And optically, what this will do is it will raise the multiple of India even higher.
Yeah.
Because
you will replace
IT services company with these companies which are very highly priced.
Absolutely. Ravi, your erstwhile favorite, Pharma, and I want to take some time out to talk about that also. With now this new spanner in the works, which you highlighted earlier today, about once again, maybe 2 years from now, 100% tariff. What would it really imply for pharma companies? Not like we've not heard this thread before, but should it actually become reality this time? What does it really mean for generics?
First of all, let's read into what he said. And you know what? It reveals more about US, and it reveals more about the kind of hollowing out of the manufacturing base US has done. So as I mentioned earlier, US has debt, US has deficit. It needs to bring manufacturing back to US. And these are areas where they are dependent on other nations. So they need to reduce that dependence. It is being driven by that. Will they be able to do it? Tariffs will only provide a window to these guys to essentially bring that manufacturing base in. Now they want same companies to do that capex. It's not like it's going to give a birth to new generic company in US. I don't think an only American company having manufacturing base only in US is going to be able to compete with other generics. Now it is still not clear whether this is only about formulations or API or even intermediates. Which part of the value chain needs to be shifted. So it might so happen that some of the Indian generic companies might put up a formulation plant over there, and which might give them a lip service and do the last end of formulation and packaging over there, but everything else of meaningful substance is still manufactured over here. So there are ways around it, and I don't see, and by the time this comes into effect, who knows whether the current president of US will be around or not around. So it in fact reveals the kind of structural strength that Indian pharma has built, and it will not be easy to replace that or just pull it out from India and put it into US. So I think the same companies, it is more a strategy change at the corporate level, corporate board level for Indian companies, where they might have to put up one odd plant or something to showcase that they are putting up a plant over there. So it works as a diversification strategy for them, but I don't think the business is going to stop. And it will be only finally the US consumer that will be paying for it. So I don't see this as a sustainable strategy to bring the investments into US. You will have to make the conditions more better. People should feel the need to put up a plant in US, not because you're being forced to, because it makes economic sense.
So you're saying nothing to panic right now when it comes to pharma for investors? Any
which way, we have a 2-year window, but I think it's something to keep your eyes on, but I don't think it's something to act upon as of today.
Okay. Ravi Dharamshi, a lot of food for thought. Thank you so much. You've given us a lot of these fantastical themes to really think about, where investors can do their homework and still make money, right?
Thank you so much. Thank you for having me.
Thank you so much for your time.